Salar Puriya Sattva. Trust, it's what we build. Presents the Realty Debate powered by Reliance Home Finance with Manisha Natarajan.
The latest round of rate cut announced by Reserve Bank of India of 0.25% was welcomed by every industry gentleman and economist. The question we are asking on today's Realty Debate, are the rate cuts seen in the last 3 years good enough to revive India's housing sector? After all, lending rates are the lowest since 2011, and that's really good news. Every cut has come as a big relief to cash-strapped industries, including the developers. My panel today, Rohit Raj Modi, Director Ashiana Homes and Vice President Credai, J.C. Sharma, Vice Chairman and MD Sobha Limited, Gulam Zia, Executive Director Advisory Retail and Hospitality Knight Frank, Harshul Mehta, CEO of DHFL, that's Diwan Housing Finance Limited, Ritesh Vora, Partner Real Estate, IDFC Alternatives. Well, gentlemen, I'm going to deep dive into the topic straight away. Rohit, I mean, as a developer, is this a big move? Is it a welcome move? Because really, this is the last that we are going to see, I think, in this financial year, not just the calendar year.
Well, it's definitely a welcome move, and I hope to see at least another 25 bips within this financial year. As I said, I hope to see. But the lack of transmission of this rate to the consumer on the ground is something which is very worrisome. Since Jan 2015, 175 bips has been, lowered. But even today, the home loan rates are between 9.4 and 9.25% in most of the places. And if you compare this to a 2006, when repo rates were about 6.25%, we had a home loan at about 7.5%. Today, at repo being at 6.5%, we still have home loans above 9%. So the spread has gone up substantially for the banks, and it's very anti-consumer.
Very anti-consumer. Well, we've got one representative of that housing finance company. I'm going to go to him a bit later. Are you also disappointed, Mr. Sharma? In fact, the new RBI governor also expresses disappointment that really it's not just about home loans. No industry is seeing that benefit percolating down in terms of the real rates of borrowing or the borrowing cost.
I do agree with what Mr. Modi just now had said. I will add some more points to that as well. As far as companies like ours is concerned, we have been able to reduce our lending rates by 200 basis points from January 2015 to October 2016. Okay. So we have been able to get this transmission done. As far as our home loan buyers are concerned, he was right. The rates still remain between 9.3 to 9.4% by most of the companies. But the silver lining is that from now onwards, it is apparent that the transmission will be faster than the rate cuts. So we have to look at what is going to happen from tomorrow onwards, then to only keep cribbing about what has not happened. We have to recognize that the balance sheets of most of the banks, they are terrible. And they have started reducing the fixed deposit interest rates only in the recent past. MCLR is also there. Tremendous amount of pressure and lots of cleaning up has happened. I am given to understand with this kind of a cleaning, the MCLR rates will keep coming down on a month-on-month basis and which will get transmitted. So I remain quite confident and hopeful that these kind of rate cuts are in the right direction and things are bound to improve from the sentiments point of view.
Mr. Sharma, I'm actually very, very happy to hear that at least as a corporate in the real estate sector, you have managed to get a 200 bips cut in your own borrowing costs from banks. I think that's a very, very huge positive, even though it's not translated into that number for home loan borrowers. But we're going to come to that a little bit later. Ritesh, what's going on? I mean, if I look at the PE data, really, 2016 is perhaps going to be the biggest year for PE funds flowing into real estate, which again makes, has the not so good about that is that perhaps companies in this business still aren't getting bank money that easily.
Yeah, that's very clear, Manisha. I think construction finance clearly has slowed down significantly, and most of the banks today, when they're lending to the real estate sector, they are obviously looking at the lowest risk product, which is typically lease rental discounting, and most of the incremental real estate financing from banks is actually happening on LRD or lease rental discounting, as I just said. Construction finance is slow and probably extremely selective, limited to the top tier firms across markets. Given the fact that operational cash flows from all real estate developers and their projects continue to be slow, clearly there is a need for external cash flows to come in for most developers, and which is where private equity funds and debt funds and NBFCs are coming in, and which is why you see that there's been reasonably consistent deal flow over the last 2-3 years as far as this particular segment is concerned.
Okay, so this money is not cheap, though. Mr. Mehta, you did announce a rate cut today. I think just about 10 paisa, but to the rupee. But it still doesn't seem to be enough. 9.35% on a home loan rate, like Rohit Raj Modi mentioned, is still too high. The spread of 3%, can it not be lowered further? What are the concerns? Yours is a very good book. To begin with, it doesn't even have the kind of, overload of NPAs which banks have.
Good evening, Manisha. Firstly, for records, I would like to state that we had announced the rate cut the same day the RBI had announced the repo rate cut.
Okay.
And we have reduced the interest rate on our home loans by 20 basis points. The best home loan rate today is 9.35%. Now, if you look at it this way, from a 25 basis cut which has been announced, we have already passed 20 basis points. And you also need to understand one thing, that as far as Housing Finance Company or DHFL is concerned, bank borrowings constitute just about 50% of our borrowings. The rest 50% of our borrowings come from various other sources. In spite of this, we have made sure that we pass on the maximum amount of benefit to our customers. Today, is interest rate the biggest concern for customers, or is it the property prices which is the biggest concern for home buyers, is one need to ask. Because in the same time frame, if we look at it, including the inflation, has the property prices gone down, or they have remained the same, or they have gone up? In the same time frame, if you see, the interest rates has definitely gone down, which has led to better affordability for people to buy home loans.
Okay, so yes, 20 basis point from 9.35 to 9.35%. That's where your home loan rate stands. Ghulam, the reason why I was waiting to come to you was to really sum up the debate on both the sides. Is it really interest rates, or is it the price of the home or affordability which is preventing this market from reviving?
Well, both obviously matter, but then to me also, what matters most is the affordability. It's about the prices. In last, when we're talking about last 6 years or last 10 or 20 years or whatever, the home loan rates have been actually fluctuating from say 6.5%, 7% to say 11, 12%. In between that, it always has been there. But property prices, if you look at a few of these markets, have actually shot up 200%, 300% and more. So obviously the big question is about affordability, and whatever said and done, if you look at the amount that you pay per lakh of your borrowing, the difference of interest cost on your overall decision for buying a house is not that huge. So I would still not completely buy this argument that a small change in home loan rates here and there will actually bring the buyers back in the market in hordes. That is not to be unless and until we have our pricing strategy right, unless the price discovery is done to what exactly the consumer is looking out for. A small change of home loan rates here and there may only add to sentiments, but then of course a lot of them would say that real estate purchases are sentimental, but then of course the first thing is affordability. If it is not affordable, no sentiments will ever work.
Ritesh, if I go to the developers, I'm going to get the most expected answer saying that, look, we've not been able to raise our prices for the last 3 years. I know they've not been able to raise their prices for the last 3 years. I've been, reeling out price charts after price charts for micro markets across India. So, And then you read a HDFC report which turns around and says that incomes have grown or by a certain multiple, so homes are actually more affordable today than they were 5 years ago. This debate is just not going anywhere. So what's your own summary, if you look at both sides of the story, on what's preventing this market from really reviving?
I think, Manisha, what we are going through clearly, to my mind, is a crisis of confidence in this market. Prices obviously are a big factor for any purchase decision, but I think prices, to a large extent in the last 3 years in most markets have been stagnant or softening, and I think most buyers today who are serious buyers also know the fact that if they sit across the table and want to close on a property transaction with the developer, they will be able to get somewhere close to the ideal price that they want. I think what is holding back buyers, to my mind, are two big things, which is why I say that this is a crisis of confidence. One is clearly whether the property will get built in time or what will be the delays, how much more would they have to shell out in terms of rent while they continue to wait for their house to be delivered. That's one very big factor, and more so especially in the last 1.5 years, as you've seen buyer activism on the rise, consumer courts coming out in the support of the buyers, and lots of such issues coming to light. That's number one. I think number two, which is to my mind again probably an even bigger factor, is that today when you see news reports on real estate, by and large everything has a negative bias, where you're saying that prices are likely to come down further, inventory levels are very high, developers are defaulting, etc. And to any prospective buyer who's looking to make the largest financial decision of their life, they don't want to come in in a situation where they buy something for 100 rupees today and 6 months later or 12 months later it's going to be down to 95 or 90. I think just like stock markets, real estate also moves on sentiment, as Ghulam said. People actually will come to buy when it's a rising market. Nobody wants to catch a falling knife. All those proverbs are actually true for the real estate market as well. And to an extent, I would be probably a lone voice, but I would say that the markets will actually recover then when prices actually start to rise, because that's the time when buyers will actually come back to markets in large numbers to buy. But for us to reach that point, obviously there is various things that need to happen in the interim. The confidence needs to come back, developers need to deliver, and developers need to feel that they have some pricing power in their hands. So I think we are still some time away from all of these things happening, and hence I would say that a 25 bips rate cut or a 50 bips rate cut is not going to do much to move the needle.
I think what we're talking about is the missing demand, whether it's because of confidence. There's no demand even for ready-to-move-in apartments. Like you said, no one wants to catch a falling knife. I look at home finance companies' loan books, they seem to be growing. Mr. Mehta, where is the demand? How is it that your loan books are growing and they're looking good and robust?
See, Manisha, if you look at the reason why the loan book is growing, there are for two reasons. One is, of course, the fact that there is also amount of balance transfer which is happening between one bank to the other bank or a housing finance and what have you. But the second aspect is also, if you look at it, you have pretty stable growth coming in from outskirts of metro locations and tier 2 and tier 3 markets, which is really holding the fort as far as the housing finance companies and the banking institutions are concerned, where I would say that you still have a fair amount of robust growth and resilience, because again it stems largely from the fact which we just heard is how the affordability is getting battered and how people are willing to take that call on the backdrop of the interest rates today, which are also fairly affordable for them to take the decision.
Okay. Mr. Sharma, now I'm going to pose a very interesting question. So we keep coming back to affordability. I have a very basic question. I feel that demand itself is not as robust as one would have predicted. There seems to be a lot of supply which is taking a lot of time to get absorbed. I look at all the economic factors. Other than the top line number of 7% growth, I'm not seeing any excitement. Gross capital formation has fallen to like 5-year low of 2.8%. You have IIP numbers which are not looking good. Are we as media probably blaming the confidence crisis too much to what's gone with real estate rather than actually looking at larger factors of how demand's panning out?
No, Manisha, you are largely right. Confidence is the crucial factor. Let me put it across in my own way. This 25 basis points reduction, in my view, is the right step, because otherwise market would have got disturbed. Today, a 25 basis point Fed rate hike, it ensures the dollar becomes costlier, gold becomes cheaper, and the movement of money from one market to other market starts happening. India is not that liquid and that large, but it does show the direction that had these things not happened, what would have happened? Number one. Number two, on affordability front, my take is the interest rates of 9.3%, with one more 25 basis point of reduction, things will definitely start looking up. Because when you have a savings rate of 7.5% and a loan rate of 9% or so, with 30% tax bracket, it helps you to borrow than to keep the money in the savings bank account or fixed deposit. Okay. Number three, according to me, that the so-called inventory part, it has been definitely over-exaggerated by all of us. We need to only look at those projects which are likely to be delivered this year, next year, next to next year, where people will be living. Now, that kind of an inventory is not that high. It is again that a question of the confidence part. Number four, when transmitting the benefits, look at HDFC's balance sheet. That single company today earns more than all the listed company from a profitability point of view. So I do believe that they have too much of a scope to reduce the rate of interest further than asking real estate developers to reduce their prices. Number five, the NBFCs also, thanks to Piramals and others today, the developers are getting loan at a much cheaper rate than what they used to get about 1.5 years back. So net, my point of view is the macro environment structurally, it is becoming much better. At micro level, customer still remains confused. Little bit of push from the macro environment with further reduction of interest cost and good sentiments will go a long way in reviving this market. In any case, despite whatever you have said, it is just a matter of few quarters. Demand is bound to come back.
All right, just a matter of few quarters. Rohit Raj Modi, would you agree with that? I mean, I don't quite agree to the fact that interest rates have a very small role to play. I mean, really for those people borrowing 50 lakhs, making sure that that EMI is serviced from a single salary, even a 0.25% cut is very, very sentimentally positive. And I would think the affordability factor automatically goes up with a home loan rate coming down. And I do agree with you that I think banks and both HFCs do need to cut rates much faster. It's just not enough. 3 and 3.25% spread is just too much.
You know, there are 2 points to this, what you just raised. From the point of the affordability of the housing stock, and as you had pointed out, last 3 years we have seen no increase in the prices. There has definitely been softening in the price, even if you don't take the headline price, but you take the kind of subvention schemes which most of the developers and most of the projects are offering, where they are picking up the tab for your pre-EMI interest cost. That would have been a cost going out of the buyer's pocket, which now the developer is willing to take on themselves. So that's a huge reduction in the price right then and there, followed by a 3-year no increase in the price. If you really look at for the inflation-adjusted pricing, I think there already is a deep cut on the price. And I don't think there's any further scope for prices to be reduced in the housing segment. Having said that, I completely agree with the point that rate of interest has a lot of role to play. When we look at a middle income segment where a home loan buyer takes a loan for 30 to 50 lakh rupee and buys a property from a 50 to 70 lakh rupee price point, saving on a monthly basis of 10-12,000 rupees is a huge amount to be saved on. And so we cannot underplay the importance of 25 bips or 50 bips. We just can hope and pray, and I agree with what Mr. Sharma said, that we should be looking at a much faster transmission going forward. If I were to just quote recently from SBI chairman's interview as well, she was talking about that we should be looking out for 1st of every month, because SBI plans to probably give its a newer rate which they do on 1st of every month. MCLR will kick in. It will look like that we should be heading for a substantial reduction. We just hope that the faster it is, and it should be in a little larger dollops. You see, this has happened in a literally like a surgical manner of 5 paisa, 5 paisa, 5 paisa. The buyer keeps on waiting that, is there something more to come? Should I wait for a more opportune time? Instead of getting a definitive signal that this is it, I should make my move now.
I know, I mean, 10 paisa, 20 paisa, well, not 5 paisa, but 10, 20 also don't make the cut at the moment when your confidence is low. Really, you need a much larger trigger. Ritesh, I'm going to come to you to conclude basically how are things looking? I mean, you're privy to the insides of a lot of real estate companies, the kind of optimism that you're trying to build on the macro factors and the fact that we could see another 0.25% cut. Do you think that this ready to move in excess inventory, I'm not even going to go into the completion or under construction, is likely to actually get absorbed in the next 2 to 3 quarters? And will we see a definite upturn?
Well, I think, real estate, each market is different. So you can't really make a broad-based statement to say that, ready to move is what it is. And, that's what's actually going to sell for the next couple of quarters or whatever. Clearly, ready to move is a preferred, way of acquiring property today for a lot of customers who especially have the worry that whether their houses will get built on time or not. So, clearly that's one very large factor, that's a risk factor that's out of the way if you buy a ready to move inventory. But, in many markets, people actually don't want to buy ready to move inventory because, the down payment that they need to make, the EMI meter that starts immediately, a lot of people are not ready for that. And, they probably don't even have, all the finances available to make such a big call immediately. I think what we are seeing, especially across markets, is that, the performance of markets as well as projects is hugely varying. There are developers and projects in the same market which are doing very well, and there are developers and projects in the same micro market which are actually suffering. I think clearly the customer is making a statement here by going to people that they have confidence in terms of being able to deliver. Obviously, right. Pricing is, to my mind, the single largest factor, and so is sentiment. But for somebody who's in the market to make a decision today, I think clearly people are going for quality. People are going for better developers who have a better track record in terms of delivery, etc. And on the pricing front, as I said earlier, I think most people know that developers are trying to do whatever they can to get inventory moving, and that I think is true for every developer, whether it's a top-tier developer or a mid-tier developer. So really, what I see is, I'm a little circumspect on 25 bips, 50 bips moving the needle, but in over a period of time, it will all add up, and hence, it will become a meaningful difference. But I think, there is going to be at least, to my mind, at least 6 quarters, 8 quarters before the market really starts to come back, simply because, all of these factors have to come together and give the confidence to people to start coming in and buying.
All right, so couple of quarters to 6 to 8 quarters. Ghulam, where do you lie, in between or larger than that in terms of revival for the real estate market?
Well, to me, I would agree with Ritesh that it looks like slightly longer. It's not something which is going to happen in 2 or 3 quarters. But one point I wanted to draw our attention towards is that when we're talking about whether it's the price cut or the home loan rate cut, well, when the price of a property, when you're buying a property, it's a price that you pay for good. A home loan rate, typically most of them have moved towards variable home loan rates. So even if I'm buying something today at a higher percentage term, after 2 or 3 or 4 quarters, if the price cut of home loan rate is coming down, then I will get the benefit. But what I buy today, the price of the product today, is going to be what I buy today. So here, the whole argument, I would still want to say that home loan is not that important a thing, because I'll get the benefit of the home loan coming down tomorrow. But the price that I pay today is the most important thing, and I would want to see that coming more affordable to me.
All right, gentlemen, I'm going to conclude there. Thank you very much for joining me. Well, a 0.25% cut, like you said, we've got 1.75% cut over the last 1.5 to 2 years, and that's no mean or a small thing which has happened. Direction is good. Hopefully, real estate will also pick up sooner than we expect. And to make that pickup happen, there are lots of festive deals going around. We'll come back and see what really works to actually get the buyer's attention. Stay with us.